Top of the hour to you. Thank you, everybody, for being prompt and on time. I do see that there's more people rolling into the room, so I'm just going to let more people enter for another 30 seconds or so, and then we will get moving. Okay, great. We have more people in this room, and I see the numbers are going up, so we'll just get started. And this is a very, very important topic. This is one of the questions I get asked a lot, which is, Steph, I have investments outside of my TSP. What should I do with them? And there's many ways you could go with that question. You could either keep the money outside the TSP, perhaps you have the opportunity to roll the money into the TSP, and whichever route you choose, we're going to go through the different options, but whichever route you choose, you have to figure out how to coordinate your decisions. There's going to be some decisions that carry with it tax ramifications you need to factor in, some decisions that carry with it liquidity ramifications. So we're going to try to address them as best as possible. But before I dive in, let me just say a quick thank you. This seminar does not happen in a vacuum. I do have my loyal clients and my members that thankfully support me, and really they're the ones that allow me to do these types of events on a somewhat regular basis. And so I thank you them. Anybody who's not yet a client or not yet a member, well, I'll talk a little bit later about some promotional opportunities for you guys to get involved, and stay tuned to the very end. I'll mention that later. So there are a number of differences between the TSP and other accounts. And when I say other accounts, I mean either IRAs, 401ks from previous employers. Perhaps you have money that is not in any type of retirement account, what is called a non-qualified account for those who are interested in the technical term. Non-qualified just means that they don't have any special retirement tax treatment. You know, anybody here who has ever received an inheritance, very likely that inheritance is a bunch of it's non-qualified money. In fact, some of your biggest assets is non-qualified. That's real estate. For many people who own real estate, whether it's your personal residence or whether it's a rental property, that's usually the non-qualified asset. So there's a lot of different ways those assets and those accounts are treated. Here are just a list of a few differences. I'm not going to go into every single bullet point over here because this is just a webinar. It's really just a 1-hour segment. The first few are the ones that I want to touch upon the most. So I'll read through this list, but the ones I'm going to focus the most are fees and commissions, the first bullet point, and then the second bullet point, investment options. The third bullet point I'll touch upon as well. So fees and commissions, I'm sure you guys know about there's fees with the TSP. There's also fees outside the TSP. I'm going to give you a compare and contrast in just a moment about that. Investment options in the TSP, they give you whatever investment options they give you. Outside the TSP, they have investment options as well, as we're going to have to compare and contrast. Withdrawal options. The TSP for many years has been very restrictive when it comes to withdrawal options. Thank goodness they introduced the TSP Modernization Act, and that is actually going to go into effect this year, 2019. All the details have not been ironed out as of yet, but they are expanding and making giving you guys more withdrawal options from the TSP, as opposed to other accounts. Other accounts usually have a lot more flexible withdrawal options, and we'll talk briefly about that as well. Withdrawal for first-time home purchase. The TSP doesn't allow you to do that. The TSP allows you to take a loan, but that's not a withdrawal of your own money to buy a first home. Other accounts will give you access to buy your first home. Creditor protection. The TSP provides some better creditor protection. The truth is, it's not just the TSP, it's any employer plan. Anytime you have your money in an employer plan, it's usually better protected than money that's outside of an employer plan because it's sort of one step removed from you. It's in that employer plan. So just a little bit layer of protection over there for creditors. Access to the money before 59 and a half. I mentioned this earlier, the liquidity need. There are some accounts that you don't have any liquidity restrictions. You could access the money right away, whether you're 20 years old, 30 years old, 40 years old, whatever it may be. Retirement accounts, you still have to wait until 59 and a half. The TSP also, you have to wait until 59 and a half. However, when it comes to the TSP and also 401ks, any employer plan, there is a technical rule that you could access it at the age of 55. So anybody here who is looking for access to money at the age of 55 from their retirement accounts, your TSP allows you to do that if you first attain the age of 55 and then separate from service. So anybody who separates from service before 55, this wouldn't be relevant to them. But anybody who's thinking about separating after the age of 55, let's say, for example, your MRA is 56 or 57. So if you wanted to separate from service before 59 and a half and access your retirement funds, you could do that in the TSP. You could do that in a 401k. You cannot do that from an IRA, however, unless you rolled your IRA into the TSP, then you'd have the ability to access that money. A little bit more just about these details. I'm just going through them very quickly because the ones I want to focus on, again, are the first two bullet points. RMD penalties. So some accounts have no RMD penalties. For example, a Roth IRA, there's no requirement to take a distribution. There's no RMD penalty. A regular non-qualified account has no required minimum distributions, and there's no penalty there. Traditional IRAs and the TSP, the traditional TSP, yes, if you don't take a distribution, then there will be penalties from that. RMD is still at work. I don't know if you guys know this. Anybody who is going to be working at the age of 70 and a half for the federal government, they will not be forced to take distributions. That's actually very important because I'll give you an example. I was giving a class, and there was a woman in the class who was age 71, whatever it was. She was still working. And she had her money in her IRA, in her TSP, excuse me, and she also had money in an IRA. And her money in the IRA was being managed by a gentleman, I don't know who it was, and she came over to me and she said this gentleman was encouraging her to roll her TSP into the IRA for him to manage. Now, she was still at work for the federal government, and because she still works, she does not have a required distribution from her TSP, but had she rolled the money from the TSP into the IRA, then that would trigger an RMD, a completely unnecessary RMD. So what I told her in that case, I said, you know what, you should speak to him, and instead of having the TSP roll into the IRA, you should have the IRA rolled into the TSP, because if you roll the IRA into the TSP and you're still at work for the federal government, you will not be forced to take a distribution, an RMD from that retirement plan if it is your employer plan. So it's not TSP specific, it's even a 401k if you're still working at the age of 70, which is becoming more prevalent these days. There is also tax on beneficiaries, and that depends whether it's a spouse or a non-spouse. That's a very, very technical thing. Just if it's usually the problems start with the non-spouse, if the non-spouse, if you have somebody who passes away and leaves their money over to a non-spouse, there could be some restrictions as to how to get that money into an inherited IRA, so they could stretch the taxation. However, if it's done incorrectly, it could trigger taxation on the entire amount, which would be disastrous. Again, that's a very technical thing. I just have it on the slide just so you know that there are differences between TSP and other accounts. Other accounts don't necessarily have the same tax treatment on beneficiaries. But the ones I want to focus in, guys, I'm sorry for that introduction, but I want to focus in on the first two, fees and commissions, and then the next one, investment options, and we're going to talk about some other cool stuff along the way. So let's start with the first one, the fees and commissions. The TSP is famous for being low fees. Low fees. And when I say low fees, how low is low? So what they have over here is the TSP fund fees, which don't stay the same every year. They actually adjust. But the TSP fund fees are in the vicinity of around 0.033%. 0.033%. So that is, if you had $100,000 invested in your TSP, that would translate into $33 a year in fees that you pay towards the TSP. So now everybody knows the TSP to be the industry leader, or the lowest in fees in the entire industry. That was true until last year. I don't know if you guys heard about this, but you should definitely look it up. If you're in front of your computers, you can Google it. You can Google Fidelity and Vanguard no fee funds or zero fee funds. So the TSP used to be the leader in the low fees. However, the competition is getting really, really aggressive. And some of them, like I mentioned, Fidelity and Vanguard, they have gone to zero fee funds. That means zero. That means you're not paying fees, like $0. So if you had $100,000 invested there, then it would be $0. Now, obviously, that's not all funds. You know, you have some Fidelity funds still have a fee, some Vanguard funds still have a fee, of course. And how high could the fees get? The fees could get pretty high. You know, if you're, especially if you're dealing with an asset manager, usually the asset management fees cap off at about 2%. I have occasionally hear that people go beyond that. Even 2% is unjustifiably high. If you are paying 2% towards your asset manager, I have news for you. You're paying unjustifiably high fees towards that asset manager, unless he is a hedge fund that is giving you remarkable returns that are consistently outpacing the market. There is really no justification for you to be paying 2% on those management fees. But just understand that if you are paying 2% on $100,000, that's $2,000 a year. That's eating away at money that could have been invested. So the TSP has the lowest fees. Until last year, Fidelity and Vanguard are now lower than the TSP with their zero fee funds. And if you go into other funds, you'll have some fees. So just pay attention very carefully to those fees as you go into those other funds. Or if you have your money in a 401k, if you have your money in an IRA, pay attention whether you're paying a fund fee, whether you're paying an asset manager for them to manage your assets. Just pay attention what those fees are and see whether or not it's justified. Now let's talk about the justification, because when you're talking about investing outside the TSP, for example, you have money in your 401k, you're wondering, should you keep it there? You have money in the IRA, you're wondering, should you keep it there? You have money in your non-qualified account, what should you do with that? So let's give a broad, let's try to frame exactly the difference between the TSP's investment options versus the investment options that you get with other investments, other accounts. So the TSP investment options, I want you guys to be very clear about something. I remember somebody came to me and they said, Stefan, you know, I like the TSP. Why? Because I really trust their investment expertise. I didn't understand what that meant, the investment expertise, because the TSP funds are mirroring outside index funds, meaning every fund you could get inside the TSP, you could get outside the TSP. And I have a list over here on this slide of the different TSP funds and the corresponding fund that you can get on the outside. I want you to notice every single one of them has a corresponding fund except for the G fund. The G fund has no corresponding index or fund outside of the TSP, and there's a very, very good reason for that. The reason is because the G fund defies the laws of finance. The G fund is the shortest duration bond fund you could own, with yields that are approaching the yield you'd get on a 4-year plus bond. It's unbelievable. Every other investor on the planet who is taking the same amount of risk that you guys were taking, they'd get probably the returns that you'd see in like a CD or something like that. You know, like about 1%, maybe probably less than 1%. But in the G fund, it depends on, you know, when you're looking at the G fund. But nowadays, the G fund is yielding around 3%. So you guys are getting 300 times the return you should be getting for taking the same amount of risk as everybody else. That is something that it defies the laws of finance. It is actually costing the federal government millions, if not billions of dollars. And every now and then, the federal government announces that they need to change the G fund. They need to do away with the G fund. And when people read those articles or they hear the news, you know what their response is? Get your hands off my G fund. How dare you touch my G fund? When the truth is, your response should be something along the lines of, thank you for granting us the G fund for the past 30 years, even though it has defied the laws of finance and cost the government billions of dollars. A little bit of gratitude, please. But just understand that the G fund is something which is, it defies the laws of finance. The TSP every now and then thinks about changing it up because it is costing the government a lot of money. And if you ever wanted to duplicate the G fund outside the TSP, you would not be able to do it because there is no such thing as a fund outside the TSP that defies the laws of finance. That just doesn't exist. Okay, but the other funds, let's for example, the F fund is the Barclays Capital U.S. Aggregate Bond Index. Again, it's a well-known index. You can get that same index outside the TSP. So if you said, Stefan, can I do F fund performance outside the TSP? And the answer is, well, it wouldn't be me. It would just be the index. That's well-known index. There are variations of the index, but it's a very well-known index, common index. You could tap into it outside the TSP. The same thing is true with the stock funds in the TSP. You have the C fund, for example. So the C fund is the S&P 500. I'm sure you guys have heard of the S&P 500, the most widely recognized benchmark in all of investing. You could invest in the S&P 500 in the TSP. You can invest in the S&P 500 outside the TSP. So when someone says to me, Stefan, I trust the TSP, the expertise of the TSP, I just don't understand. What do you mean? You mean the S&P 500 in the TSP is better than the S&P 500 outside the TSP? I don't understand exactly what you're saying. So that needs a little bit of explanation to me. But my point is, I'm hyperbolizing it. But the point is that any fund that you wanted in the TSP, you could get outside the TSP. So if you wanted to duplicate your TSP holdings outside the TSP, you could do exactly that, except for the G fund. You could do everything else outside the TSP. Okay, the S fund has the Dow Jones U.S. Completion Total Stock Market Index. The I fund is the Morgan Stanley Capital International EFA, the MSCI EFA. Again, all these are accessible outside the TSP. So now, if you could do outside the TSP the same thing you can do inside the TSP, so then how do you choose which one is better? So obviously the fees, as I just mentioned. So if you have the same exact thing, but one's lower fees, one's higher fees, so then why not do the lower fees if you're getting the same exact thing? That's wonderful. However, when you go outside the TSP, you'll see that there's not just 5 investment vehicles. There are other investment vehicles out there, and that's very important to recognize the benefits of having those other investment vehicles. Let's explain the difference of those other investment options. Inside the TSP, whether it's the S&P 500, the Dow Jones Total Stock Market Completion Index, the Morgan Stanley Capital Index EFA, the Barclays Aggregate, all those are broad market exposure. Broad market exposure. You're not owning one stock, you're not owning a sector, you're owning the broad market. Okay? Now, when you go outside the TSP, you could do the same broad market exposure. As I mentioned, the same funds are available outside the TSP, the same index funds are available outside the TSP. However, you also could get more specific in your holdings. You could get more specific. You could own, instead of the broad market, you own individual sectors of the market. So you could own like the retail sector, the financial sector, the healthcare sector, all these different sectors. You could own, sectors. Or if you want to, you could get even more specific. You could own individual stocks. Now, I'm sure you can see on this slide, it's a continuum. There is broad exposure and specific exposure. And when you move from one side of this continuum to the other, so what you're going to see is that when you're doing the broad exposure, you have less of things. And when you do specific exposure, you have more things, which is very funny because when you broad exposure, you have more investment options. You're exposed to the broad, so that means you're exposed to a lot more, but it comes along with a reduction in many things. As opposed to specific, it increases many things. So let's give an example. When you are exposed broadly, so you have less upside exposure and less downside exposure. As opposed to if you invested specifically, let's say in a specific stock, you'd have more upside exposure, but also more downside exposure. Let's illustrate with a couple of examples. So the S&P 500, inside the S&P 500, you have the top 500 United States companies. And on that list are companies that you probably heard of, like Amazon, right? And Microsoft and Facebook. So you've probably heard of these companies. Now, for those who are watching, the C Fund in 2018, do you guys remember how the C Fund did last year? In 2018, I know it wasn't too long ago, it was just a month ago. In 2018, the C Fund lost about 5% for the year. You could check up the numbers on the TSP website, but it's about 5%. Maybe it's a little bit of a fraction, but 5% in that vicinity is what the C Fund lost for the year 2018. Now, that's funny. In the C Fund, which includes Amazon, includes Microsoft, you were down 5% for the year. But had you had Amazon and Microsoft specifically, well, Amazon was up like what was it up? I don't even know, 30 something percent for the year. Microsoft was up, what, 20%, maybe 18, 20% for the year, in that vicinity. So because you had broad market exposure, you actually didn't get the full benefits of having an Amazon specifically or having a Microsoft specifically. Had you just had those specifically, you would have had gains in 2018 as opposed to losses in 2018. However, by the same token, you were not invested in Facebook. If you had investments in Facebook specifically, well, what would you have lost? 25% in 2018. So instead, you just had broad market exposure, which lost you 5, as opposed to having Facebook, which dropped 25%. For example, I'll give you another example. GE, General Electric. General Electric in 2018 lost 57%. 57. I want you to know how bad that is. GE started off 2018 as part of the S&P 500, but its capitalization, because the stock dropped so precipitously, its capitalization shrunk, and it no longer was eligible to participate in the S&P 500. It just didn't qualify. It was the capitalization shrunk because it dropped 57%. So mid-year in 2018, GE fell off the S&P 500 because it just shrunk in size because the stock was doing so poorly. So as you can see, if you have broad exposure, you have less on the upside, but you also have less on the downside. If you have specific exposure, then you have more of the upside, but you also come with more of the downside. Now, that's also important to recognize because you'll see on the same slide that final bullet point. When you have less upside and less downside exposure, it requires less monitoring. You don't have to pay attention because there's not really such big news that's going to like sideswipe the entire market at once because you're exposed to the entire market. So when you're monitoring the TSP, you shouldn't be looking at specific performances of stocks. You need to be looking at the performances of the broad market, and broad market performances don't change much on a daily basis for sure, and on a monthly basis, right? They don't really change so much. It's gradual changes, and that's something that changes much. That is something that I monitor on a month-to-month basis, and it actually makes my life easier because broad market exposure, I just watch what's happening in the broad market. Are companies hiring? Are companies not hiring? Is GDP going up? Is GDP going down? Is manufacturing and production going up? Is going down? So I'm able to watch these broad trends in the market, and I don't have to watch anything specific. I can just watch broad trends, and I'll pretty much have a guess, a good educated guess as to what the TSP is going to be doing. As opposed to if I was going to be invested in specific stocks. So for example, if I was invested in Facebook, so then I need to be paying attention very, very closely to that Facebook. I need to be paying attention to that because it could be that some specific lawsuit comes out against Facebook. Or I don't mean to pick on Facebook. I don't mean to advocate any stock or any fund. I'm not advocating anything. I just give you as an example that you had specific holdings. You need to monitor that a little bit more specifically. So when you go outside the TSP, if you have investments in IRAs or 401ks, they probably will provide you broad exposures, but they also should provide you with more specific exposures. And if you have the ability to participate in more specific holdings, you have the ability to claim more upside, but you also expose yourself to more downside, and it does require more monitoring. By the way, on this spectrum, you have on the one side, you have broad market exposure. On the other side, you have specific stock exposure. There is a medium. I don't want to say a happy medium because it comes along with its risk and rewards as well. But there is a medium. You could have individual sectors, as I mentioned before. So this way, you're not just exposed to one stock, but you have the sector of, let's say, retail or the sector of financials or whatever it may be. You have those different sectors. So by having specific sectors, you also expose yourself to a little bit more of the upside, but you also have a little bit more of the downside than you would had you had broad exposure. But because it is sector and you have a whole bunch of holdings in one sector as opposed to one individual stock, it requires less monitoring. So those are things you could benefit from if you go outside the TSP. So anybody here who has money outside the TSP, let's say you have it in a 401k, let's say you have it in an IRA, let's say you have it in non-qualified investments. Well, all those should give you the ability to invest your money in more specific holdings, whether it be individual stocks or whether it be specific sectors, something that's a little bit narrower than just the broad market exposure. But if you said, you know what, Stefan, I just want broad market exposure. I just want to set it and forget it, not monitor it. I don't care about pursuing upside. I just want to minimize my downside with as little monitoring needed as possible. Well, then the TSP provides you with that. It happens to be, just I'll throw it on the side, I'm sure you guys have heard this from me in the past, I'm not a big fan of the international exposure you guys have in the TSP. The I fund is something that I'm just not happy with. If you wanted to have international exposure at all, then you probably would want to venture outside the TSP. But if you just said to me, Stefan, no, I'm happy with domestic exposures, and the TSP provides me with the S&P 500, which is 500 companies. That's, by the way, you should have 500 companies with spanning a spectrum of sectors, and also has a presence internationally as well. So you have very strong, adequate diversification in the S&P 500. Again, I'm not promoting the S&P 500, and it has to be coordinated with all the other things happening with your investments. But if you just said to me, Stefan, I just want to have one type of investment, set and forget it, and I have no liquidity needs, and I have all my investment needs are exactly the same, then I would say, the broad market exposure inside the S&P 500 is totally fine by me. It's again, you have my vote, that's a good place to be. But if you said to me, Stefan, I want to be more specific, I don't want to suffice with just S&P 500 performance. I want to see if I could capture some performances which are like Amazon or like at Microsoft, the individual exposures or even the sector exposures. Then outside the TSP, you should be able to get that outside the TSP. Okay, let's go a little bit further. And I want to talk about the taxation. This is going to be a very important conversation. Now, when it comes to taxation, so you have the taxation of your TSP. I don't know if you guys know this, but any money that comes out of your TSP is going to be taxed as ordinary income. So on this chart over here, you see on the left-hand side, any money is going to be treated as ordinary income. So that means if you have money inside your TSP and you take it out during retirement, you should be expecting to pay ordinary income tax rates. You're not going to get any tax breaks on that. You're going to get the ordinary income tax rates. Very good. Now, if you have money in a 401k and an IRA, you're also going to be paying ordinary income tax rates, unless it's a Roth, because by Roth you don't pay taxes on your withdrawals. You just pay taxes on the way in. You don't pay taxes on the way out. So you have those. Those tax rates. So fine. So I want you to pay attention to these tax rates. If you're outside a retirement plan, if you're outside a retirement plan, meaning you have money in non-qualified investment accounts, and I would ask you guys, think to yourself, do you have any money that's not in a retirement account? If you have money that's not in a retirement account, that's a non-qualified account, and those non-qualified accounts could be taxed in one of two ways. It depends whether you have short-term capital gains or long-term capital gains. You also may have bond income. So let's go through the taxation of those very, very quickly. We're going to talk about interest interest that you get from your bonds or from your CDs. Those are ordinary income. That's interest that gets taxed as ordinary income from your bonds. The only types of bonds that get taxed differently are, I'll give you a few examples, like muni bonds. Muni bonds are not taxed on a federal level. They're also not taxed on the state level if you live in that municipality. So then it's not taxed on the muni bonds. However, and let me give you another example. The educational savings bonds. If you have educational savings bonds, the interest of the bonds, if it's used for qualified educational purposes, that also you don't pay tax on that. However, every other bond that issues interest payments, you have to pay ordinary income tax on those on that interest. So just remember, bonds get taxed as ordinary income. It's not the bonds, it's the interest that get paid. You have to tax as ordinary income. But just remember that, because I'm going to come back to that in a second. The next thing is the capital gains. The next thing that the capital gains. There's different types of capital gains. You have short-term capital gains, you have long-term capital gains. Now, before I talk about short-term and long-term, do you guys understand what capital gains are? I think we all do. I'll just spell it out a little bit. A capital gain is if you bought an asset and the asset appreciated in value and you sold that asset, you'd have a capital gain. So let's say you bought a share of a stock for $10 and then the stock went up to $12 and then you sold it. So then you'd have a $2 capital gain. Now, how do those capital gains get taxed? So it actually depends on whether those capital gains were made on a short-term basis or on a long-term basis. So for example, you see on the side, short-term capital gains. A short-term capital gain is if you bought an asset and you sold it within 365 days. If you bought an asset and sold it within 365 days, that's a short-term holding, and those capital gains get treated, you see the tax rates, they're pretty much treated like ordinary income. Because if you're buying and selling on a short-term basis, in the eyes of the IRS, They just call that a side job. All right. There's plenty of other people who buy and trade on a short basis. They're called day traders. Now you may not consider yourself a day trader, but if you are buying and selling on a short-term basis within the 365 days, that means you're sort of acting like a day trader to some degree, and the IRS views that as a side job that you may have, and you pay ordinary income rates, ordinary income tax rates on those short-term capital gains. On the long-term capital gains, so those long-term capital gains, if you bought an asset and then held it for 360 6 days or more, you held it for more than a year, 366 days or more, then you'll see that your long-term capital gains tax rates are much more beneficial than the short-term capital gains rates, and they're much more beneficial than the ordinary income rates. So if anybody here has money outside the TSP in a non-retirement account, those accounts can enjoy long-term capital gains tax treatment. Long-term capital gains tax treatment. So if those accounts could enjoy long-term capital gains tax treatment, that's something we should keep in mind, because when we have the money in the TSP, it's going to be taxed in one way. When you have the money that's in the non-qualified account, it gets taxed differently. So we should possibly think about how we allocate our money within those accounts. Let's actually give some examples of this. I'm going to skip to the next slide. Okay, because I want to talk about these non-qualified accounts. And in this conversation about non-qualified accounts, you'll start hearing a little bit more about how you should allocate your money within your taxable accounts, within your TSP, within your 401k, within your IRA. Like how much should you have in stock? How much should you have in bonds? It's all going to come down to like the tax treatment and also the level of aggressiveness that you want to have in your account. So let's talk about the benefits of these non-qualified accounts. And again, I'm mentioning non-qualified accounts, even though I understand that many of you, the bulk of your investments are inside your retirement accounts, inside your TSP. However, some of you will have non-qualified money, and it's important to understand how to invest that non-qualified money, because that's money that's going to be taxed sooner than your TSP, perhaps. Also, it's important to understand these non-qualified accounts, because I have news for you. Anybody who reaches the age of 70 and a half, the IRS is going to force you to take distributions, and any distributions that you don't end up spending, you're going to probably want to invest that money. And where's that money going to go? It should go into a non-qualified account. And so that's one of the things which I try to encourage people, that when they get those RMDs and they don't spend it, they should put it into a non-qualified account and invest it, because if you don't invest it, you just put it in cash, it's not going to be growing. So let's talk about this, the benefits of non-qualified accounts. There's 5 bullet points on this slide. The first bullet point is a convenience bullet point. The last 4 are tax bullet points. So let's talk about the first one. We mentioned this earlier. The non-qualified accounts have no liquidity restrictions. You can access penalty-free anytime. You don't have to wait to the magic age of 59 and a half. I mentioned that earlier. So anybody who said to me, Stefan, I have money outside my TSP, it's in a non-qualified account, I would ask them, do you need to have that money on a short-term basis? If you have any liquidity concerns, are you going to need to tap into it on a short-term basis? If you said to me, yes, Stefan, I need to tap into that money on a short-term basis, then I would say to you as follows. A short-term basis is usually 3 years or less. Sometimes some advisors would say 5 years or less. That's going to depend upon the level of risk. But if you ask me, 3 years or less is a short-term basis. If you have money that you need on a short-term basis, the money that you literally going to be spending, all that money on a short-term basis, all that money, not some of the money, but all the money that you're going to be spending on a short-term basis within 3 years, that money should not be invested in stock, because stock is just way too risky on a short-term basis to invest in. So anybody here who has money that they're going to be spending all of that specific money should be invested in conservative instruments such as bonds or such as the G fund. That's the general guidance over there. So if somebody says, Stefan, that I don't need the money so soon, so then you might not need to tap into the money on a short-term basis. You might be able to wait more than 3 years, preferably 5 years. If you give it 10 years, that's even better. And that money could be positioned more aggressively. Okay, that's just a convenience standpoint. Let's go into the next bullet points. The next bullet points are tax sensitivities. Now, guys, I warn you, we are about to get into tax sensitivities, which could get super duper technical. So try to stay with me on this one, because it's really here where a lot of money is made. It's a lot of money made for you, and if you play your cards correctly, you'll not just make money for yourself, but you can also leave over more money to your children as well. So the next consideration. The non-qualified accounts can receive the favorable long-term capital gains tax treatment So you remember I mentioned earlier the money that comes out of your TSP. How does that get treated? It gets taxed as ordinary income, and those ordinary income tax rates. Let's back up to that. Those ordinary income tax rates are not as attractive as those long-term capital gains rates. They're not as attractive at all. Now, you may think that you have long-term gains because you've been invested in the TSP your entire life. I have news for you. Even if you've been invested in the TSP for 30 years or more, all the money that comes out of the TSP is not treated as a long-term capital gain. It's all treated as ordinary income. The money that comes out of your non-qualified accounts, that gets treated as a long-term capital gain, and that gets the favorable tax benefits. So now, I'm going to illustrate this to you with one of my favorite examples. I'm sorry, I was doing this very, very quickly, and so don't mind that it's so small and crooked. Okay, but what we're looking at over here is an investor. This is actually a case. One of my clients came in. This is one of my favorite examples. They came into me with a portfolio of $1 million. For those who've come to my class, I'm sure you've seen this illustration from me before. They came to me in $1 million portfolio. How were their $1 million structured? They'd half their money inside the TSB, and they'd half their money inside the non-qualified account. So that means $500,000 in the TSB, $500,000 in their non-qualified accounts. Again, remember, non-qualified means non-retirement for purposes of this conversation. So before I go on, let me just note, that is unusual. That a person have half their money in non-qualified accounts, half their overall invested portfolio in non-qualified accounts, that's something which I don't find too often. If I was to guess on the people who are on this webinar, if I was to guess what percentage of your money is in non-qualified accounts, I'd guess 10 or 20%, depending upon what your ages are. But let's just say 20% of your money was in non-qualified accounts. The other 80% would be inside your retirement accounts. Your TSB probably is the bulk of it. Okay, but this person came to me with half the money in non-qualified, half the money in the qualified TSB accounts. Wonderful. And they also had their allocation looking as follows. Now pay close attention to this allocation. You'll start hearing the magic. They had in the TSB, they split their account 50-50. That means the TSB was half stock, half bond. Their non-qualified account was also 50-50. That means it was half stock and half bond. Now, before I make any investment recommendations, I have to know a lot about my investors. I have to know what their investment goals are. I have to know what their time horizons are, liquidity needs, risk tolerance. I have to know if they're employed by certain governmental agencies which prevent them from investing in certain assets. In this case, I don't have to know too much about this person, and I can spot there's something going on in this portfolio. Can anybody spot what the issue is with this type of allocation? So because it's a webinar format, I'm just going to have to speak it through for the sake of time, but follow me along with this. The money inside the non-qualified account. So we have stock, bond, and a non-qualified account. Let's start with the bonds in the non-qualified account. The bonds in the non-qualified account, how do those get taxed? Now, if you remember, bonds issue interest payments, and interest gets taxed as ordinary income. Okay, how do the bonds inside the TSB get taxed? Bonds inside the TSB, well, if you remember, everything in the TSB gets taxed as ordinary income. Interesting. So that means the bond portion of your portfolio outside the TSB, from a tax standpoint, is not going to be taxed that much differently than the bond portion of your portfolio inside the TSB. Oh, that's interesting. Let's move on to the stocks. The stock portion of this person's portfolio in the non-qualified account. How does that get taxed? Well, if it's in non-qualified accounts, then it can enjoy those long-term capital gains tax rates. Remember those favorable long-term capital gains tax rates? Very, very good. What about the stock portion of the TSB? How does that get taxed? And the answer is ordinary income. Oh my goodness, the stock inside the TSB could have gotten long-term capital gains tax treatment, but unfortunately it's trapped in the TSB. It's trapped in the TSB where everything gets taxed as ordinary income. So when I saw this, I pointed out to them, I said, I think you have a tax inefficiency in your portfolio. Let me suggest how you could fix this. Now pay attention to this suggestion because there's a lot that you can learn from this, just this one illustration. What I suggested is as follows. The bonds in the non-qualified, they were going to be taxed as ordinary income. And since we know that everything in the TSP gets taxed as ordinary income, I suggested that they relocate the bond portion of their non-qualified into the TSP, where everything gets taxed as ordinary income. And also, I suggested that they take the stocks in the TSP, which are trapped and being taxed as ordinary income. You move those stocks into the non-qualified account. And once it's in a non-qualified account, then it benefits from those long-term capital gains. How does this help them? Think about this. How did this maneuver just help them? I'll tell you how it helped them. The stock portion of their portfolio, which represents $250,000 of their portfolio, was going to be overtaxed. Overtaxed. Are you with me in this? So I suggested that they move the stock portion, which was going to be overtaxed, into the non-qualified account where it could enjoy those long-term capital gains rates, which are much more favorable. I thought it was brilliant. They thought it was stupid. They looked at me and they said, Stefan, hear what you are saying. Because if I follow what you're saying, Stefan, the result is going to be that my entire TSP is going to be in bonds? That's ultra-conservative. And if I'm following you, Stefan, the result of your switcheroo is going to make my entire non-qualified account all stock. That's super aggressive. That's nuts. So I had to explain to this person that they came into my office as a 50-50 investor. And when I made the switcheroo, they still are a 50-50 investor. Nothing changed in their overall allocation. The only thing that changed was $250,000 of the money that was being overtaxed is now switched to non-qualified accounts where it will not be overtaxed, but instead it will be undertaxed. It will get those long-term capital gains rates. Okay. Now, at this point, I usually get asked a couple of questions. And the questions go as follows. Question number one, Stefan, I hear you saying that that if I have this non-qualified money, that it should be stock, and if I have the TSP, it should be bonds. But please tell me, how do I get the stock out of my? How do I get the stock out of my TSP into my non-qualified, and how do I get the bonds from my non-qualified into my TSP? That's one question I get asked, and the answer is you don't have to make that change. All you do is an inter-fund transfer, and on an inter-fund transfer, you'd be able to satisfy all these. Okay. You could be able to switch your TSP, for example, if it's stock, CS, and I, you could do an inter-fund transfer and move it into bonds. Okay, that's the first question. The second question is, okay, so should I follow your advice, Stefan, and move my entire TSP into bonds, my entire non-qualified account into stock? And the answer to that is absolutely not. Whoa, whoa, whoa. I want you guys to be very careful over here. In this client's case, I suggested the switcheroo, which would end up with an entire TSP of bonds, an entire non-qualified account of stock, because that would preserve her overall 50-50 allocation. But if you guys have 80% of your money in TSP and you move that all into bonds and 20% of your money inside the non-qualified, and that'll make it all stocks, then you won't be 50-50 anymore. Then you'll be 80 bonds, 20 stock. That's probably not the way you should be. The point of this illustration, however, is to point out that the stock portion of your portfolio, if you have stocks in your portfolio and you have non-qualified money, that non-qualified account should be loaded up with the stock, because the money that's inside that stock in the non-qualified account could benefit from those long-term capital gains rates. So if I were to ask you guys, does anybody here have long-term have non-qualified accounts? If you have non-qualified investment accounts and you don't need that money on a short-term basis, but you could hold it for a long-term basis, ideally 5 years or more, as I mentioned before. So then that money could be positioned with stock, and then you'd be enjoying those long-term capital gains. Okay, I hope that that makes sense. I'm not saying that your TSP should be all bonds. No way, no way. Especially if the TSP is the vast majority of your portfolio, I'd be nuts to suggest such a thing. But I am suggesting that the non-qualified portion of your portfolio could really enjoy those long-term capital gains rates. Okay, let me go a little bit further, guys. I'm going to back up a second. No required minimum distributions. Let's keep this in mind. When you guys turn 70 and a half, you will have forced distributions. Because you will have forced distributions, those forced distributions will the IRS is basically going to be saying you have to take money out of your TSP whether you like it or not. So now, if you think about that, if the IRS is forcing you to take money out of your TSP, then the result of that is that the TSP is going to have to liquefy some of its money. Now, here's the thing: if your TSP, if you have an account that has forced distributions, let's say the TSP has forced distributions. When you have forced distributions, could you afford volatility? Because volatility, goes up and down, and stocks are more volatile. So if you have stocks in your TSP and stocks are up and down, up and down, up and down, and you have a forced distribution, could your TSP that's volatile afford a forced distribution? All right, or let me say that if your TSP has a forced distribution, could it afford volatility? I'm sorry if I'm fumbling my words. Could your TSP, which has a forced distribution, afford volatility? And the answer is as follows. Well, it depends when that forced distribution comes. If the forced distribution comes when the TSP has been up, that's perfectly fine. But if the forced distribution comes when the TSP is down, well, then that's actually a problem, because when it's down, if the market has been beaten down and you have a forced distribution, that's just going to beat down your portfolio even further. So I would suggest anybody here who has a TSP or a 401k or an IRA, you have to ask yourself, am I going to have to take forced distributions soon in the near future? If you will have to take forced distributions from those accounts in the near future, you need to have some of that money in not aggressive, not in a volatile instrument. You need to have that money in conservative instruments. So anybody here who's forecasting an RMD in the near future, again, I would say within 3-year period of time, you should probably be moving some of that money into a conservative instrument at this point in your career. You should probably be moving some of that money into the G fund or to bonds. Let's go a little bit further over here. You can harvest the capital losses. The capital losses are only a benefit if you had a capital loss in your non-qualified account. So once again, anybody who has non-qualified assets, they should have that money invested in a way that could give you the best treatment for capital gains taxes, and also the best treatment for capital losses for taxes. And again, that's going to come in the stock portion of your portfolio. The last bullet point on this slide, I'm not going to get into. That's the step up in cost basis. The step up in cost basis is something which will help your kids. If you have non-qualified money, which you will have when those RMDs kick in, they'll force you into non-qualified money. But if you have those non-qualified money, you want to have those non-qualified monies get the best, the biggest gains. And then when you pass away, that money will pass along to your children, and they would have a step up cost basis, which would minimize their capital gains. Okay, let's take just a step back and let's try to summarize what we're saying over here. Okay, so anybody who was not staying with me with the taxation because it was getting very technical, now let's come back to and let's talk about it. A little bit of a summary. The first thing you need to know about your investments outside the TSP is that your investments outside the TSP, they will allow you to invest broadly and more specifically. And when you invest more specifically, you have the ability to pursue greater returns, and you have the ability to pursue greater returns. You have greater exposure on the upside, more exposure on the upside, but you also have more exposure on the downside, and it also requires more monitoring. So anybody here who has money outside the TSP, if you are interested in pursuing higher returns by being more specific in your holdings, so then you could keep that money outside the TSP and just put it in instruments that are more specific than what you have in the TSP. When I say more specific, I mean you already have the S&P 500, you already have the Dow Jones. If you wanted to shrink and become a little bit more sector specific or stock specific, that is where something outside the TSP would be more beneficial. However, when you go outside the TSP into more specific, be aware it's going to expose you not just to higher upside, but also to higher downside, and it does require more monitoring. Also be aware, I mentioned to you that Fidelity and Vanguard have zero fee funds, but if you're not using their zero fee funds, you're probably going to be paying higher fees. Now, higher fees is not necessarily a problem if you're pursuing those higher returns. That's not necessarily a problem, but you just have to understand the trade-off that you'd be getting. That was the original point we made. Then the other point that we made was the tax benefits that come along from these outside accounts. If you have money in your Roth IRA or money in a non-qualified account, those accounts do not have forced distributions. And because they don't have forced distributions, they could afford volatility. So money in a Roth IRA, money in non-qualified accounts, those usually should be stock. Anybody who here has Roth money, anybody who has stock, who has non-qualified money, that money in general should be stock. It could benefit from those long-term capital gains rates if it's non-qualified. It doesn't have any forced distributions, so then you could be as volatile as you like, and don't worry about the IRS forcing you distributions. And if you have non-qualified money, you can also benefit from any losses that took place. We don't want to have losses, but if we had a loss, we could benefit from all those things. These are just the different considerations that you should have in mind when you're looking at your money outside the TSP. Does it give you more specific investment performance? More specific meaning greater upside exposure, but also greater downside exposure. That is something which I don't discourage. I don't want to encourage it because it really depends on your stomach, but I don't want to discourage it because, as I mentioned, if you had Amazon this year, you'd be looking very, very nice. You did have Amazon in the S&P 500 in the C fund, but unfortunately, you didn't just have Amazon. You had all those other companies, and your C fund went down 5%. Amazon was up plenty more, but plenty in 2018. That's just a specific example. I'm not advocating for Amazon. I'm not advocating for any specific stock, but just so you understand the benefits of going into more specific holdings. With that being said, I'd like to open up the floor to any questions that you guys may have. There's a chat on the side, and I'm going to be opening up the floor for questions. So if anybody here has any questions, by all means, please chime in on the side. And also, after the questions, I wanted to tell you about a small promotion that I'm going to be offering. So let's look at the questions on the side over here. I see some things. Oh, I like a lot of conversation taking place over here. This is good stuff. So can you move a 401k? If I have a 401k and it's not in the TSP and I have separated, and I've not separated, excuse me, and I've reached 59.5. So Janice, if I understand your question, you have a 401k, it's not the TSP, you have not separated, and you're 59.5. So the answer to that question is the 401k plans, if you are working for the federal government, that means you've separated from that employer. And so if you separate from that employer, then yes, at the age of 59.5, yes, 59.5, you can access those retirement funds. So I hope I'm answering your question, Janice. I think I understand what you're saying, that you have a 401k. You're right now a federal employee. You also have a 401k from a previous employer, and you're 59.5. You want to know, can you tap into that money? Yes, you can tap into money because you are 59.5, which means that you are old enough and mature enough to handle your own money. Okay, let's go to another question. Okay. So the last in, so LIFO and FIFO. So let's explain to people what LIFO and FIFO mean. LIFO means last in, first out. FIFO means first in, first out. So let's say, for example, I bought a stock 10 years ago, and then I bought a stock yesterday, and then I sell it. So last in, first out means that I sold the most recent purchase. First in, first out means that I sold the one that I purchased 10 years ago. So which one is the better option? Now, if you think about it, it's going to depend upon the embedded gains. Meaning if you have an investment from 10 years ago, you probably have larger gains in that. If you have an investment from 1 year ago, you might not have gains at all. You might have losses. Now, if you could sell an asset at a loss and reap the capital loss, and that could help you reduce taxable income, then sure, take that. Or if you wanted to, if you had a gain, let's say you had a short-term gain versus a long-term gain. If you wanted to capitalize on the long-term gain, if you want to capitalize on the long-term gain, so then selling the first asset would be giving you long-term capital gains, which get taxed at a lower rate. If you sold the one that you purchased during this year, which let's assume it had a gain, that would be a short-term gain, and the taxes would not be as beneficial. So we have another question from Bob. You said if you would be forced to take distributions on some funds in the future, you should begin moving those funds into conservative assets to avoid being liquid stocks. When doing that, should you do offsetting things in the rest of your portfolio? Okay, so now that's a great question, Bob. So when a person is approaching a period of their life where they have distributions coming from their portfolio, and those distributions are going to be either forced distributions from that the IRS forces RMD, or they're going to be non-forced, that you just need it for income purposes. You just want to take a distribution, excuse me, for income purposes. So if you are So regardless of the situation, of whether you're taking it for RMDs or whether you're taking it for just income needs, you need to make sure that you have a portion of your portfolio that is carved out and put into conservative money for short-term needs. Short-term, whether it be for income needs, or short-term, whether it's for a forced distribution need. You need to have that money carved out. And then what you also need, Bob, is you need to have the ability, when you take your distributions, to specify where you want the distribution to come from. Do you want it to come from the carved out money, or do you want it to come from the other money which has not been carved out? If you are going to be taking distributions, you also want to have the ability to specify where those distributions come from. That is one of the shortcomings of the TSP. I have to admit that even with the TSP Modernization Act, that is one of the shortcomings of the TSP, that you will not be able to specify which fund you take your money from. So for example, let's say you carved out a part of your portfolio and put it in the G fund, and the rest of your money you had in the C fund. Let's just give that as an example. And then it came time for you to take a distribution, and you said, I only want my distribution coming from my carve out, coming from my G fund money. They won't give it to you just in that. They give it to you from all the funds pro rata. It's a little bit annoying. There is a workaround, and I don't really have time to get into the workaround, but there is a workaround, just so you know, but that is a little bit annoying. You want, if Bob, to answer your question, you want to be able to carve out some money for short-term purposes. The rest of the money you could be aggressive. I have a video about that I put out like 2 weeks ago. So if you look on my YouTube channel, you'll be able to see a video about that, about explaining the math behind that. You have to be able to carve out, and in addition to carving out, you also have to have the specificity, the ability to specify that you're taking it from this money and not from that money. Let's go to Scott's question. I maxed out my TSB. My wife has a 403B, but no matching. Is it better to contribute to her 403B or go outside into non-qualified investments? So the answer to that question is, that's a great question, Scott. You should know my hierarchy of investing. My hierarchy of investing goes as follows: Roth, non-qualified, and then traditional. Roth, non-qualified, and traditional. So if you said, you know, I could invest in my wife's 403B, but not in a Roth, I don't do traditional, then I would say, well, if you're not doing Roth, then maybe you should look at non-qualified. But if your wife's plan has Roth, which I'm assuming she does have a Roth in her non-qualified plan, then I would say look at the Roth option. I'm a big fan of Roth in general. By the way, when I say Roth, non-qualified, traditional, there is a category above Roth, which is the HSA, but that's a different conversation. I don't want to include that in this conversation. Okay, guys, it happens to be that I need to wrap up the class because I have a train to catch. So I can't stay on board a little bit too much longer. But I would like to invite everybody here to think about not just their investments, but really their overall financial picture, because the investments are just one piece of the puzzle. You really have to coordinate your investments, not just with your other investments, but with your first pension, with your Social Security, with all the other things that are happening in your life. So I would encourage you guys to think through not just your investments, but also everything else. And I would like to help you think those through. And the way I would do that is with my financial planning program. I have people who join me for full financial planning. I have people who join me for a more specific and concierge type of financial planning service. But either way, I do have a financial planning service, and I encourage everybody here to join that financial planning service ASAP. Like when I say ASAP, I mean right now. On the side of the chat bar, there's a bullhorn, which is it's for my financial planning service. If you wanted to sign up, you could sign up with a promotion. The promotion would lock you in at a lower rate than usual. My regular rate from a financial planning service, if you're doing the monthly rate, so there's the regular rate is $45 a month, and then the promotional rate will give you for $35 a month. $35 a month for the concierge service. That's not the full financial planning, but nonetheless, it is a starting point. It's one of my lower tier programs for financial planning. I would encourage everybody here to start some form of financial planning. And whether you're going to do the full financial plan with me or whether you're going to do the concierge service with me, the best way to do it is by getting started right now. And there is a link in the promo code. You'll actually see it. It's over there. If you press start now, you'll be taken to a web page. And that web page, I'm going to put the web page in the chat right now. So anybody who's in the chat, you could look at this link. Okay, I just did that in the chat. So anybody who's there, you can see that link. And don't forget to enter this promo code. And the promo code is going to expire in just a few days, the January 30th. So the promo code is New Year 19. Okay, enter that promo code and then you'll get the discount. And I would encourage you guys to start planning now. Anybody here who has investments inside of TSP or outside of TSP, anybody who has a financial life, that really needs to be just organized and strategized and maximized. This program is going to help you accomplish that, and I look forward to working with all of you. Thank you all for whoever joined this webinar today. Tell your friends that they should be joining future webinars. Also remember that for those who came to this webinar today, even if you just registered, even if you didn't show up, but just registering gives you access to the replay. So for those who are here, great. For those who are not here, you'll get the replay link via email in just a little bit after this webinar. I'm signing off, guys. I wish you all good luck, and I look forward to working with all of you.